We've got ADP crossing the wires. Let's get to him.
Minus 33,000. ADP saying that non-farm payrolls declined by 33,000. That's substantially below, for the second month in a row, the estimate of 100,000. It is the only decline since March of 2023. Goods sector not doing too badly, up 32,000. The losses appear to come from the services sector. We'll show you details in a second, of minus 66,000. And there's the non-farm payroll estimate, which includes government and the private sector, for tomorrow, Thursday, remember, folks, and that's 110,000. It's the second weak month in a row for ADP after downwardly revised 29,000 for May. But it's been running, by the way, substantially weaker than the BLS private sector numbers. We'll give you that in just a second. But first, let's look at which sectors were affected. Small business down 47,000. There's been a lot of speculation as to whether or not the tariffs would be hurting or hitting small business, down 47,000. Medium-sized business down 15,000, but large businesses doing okay, up positive 30,000. The losses were in this professional and business services sector, minus 56,000, but also one of the stalwarts of the job market, education and health services, down 52,000. Financial activities down 14, but manufacturing up 15, and leisure and hospitality still doing well, up 32,000. As for wages, the 4.4%, this is, by the way, called for millions of paychecks out there, so it's actually better than the government data. It is up 4.4% for people staying in their jobs. That's down a tick, and 6.8% for job changers. That's down 0.2 from the last month. Note that the average absolute difference, without care to sign, between ADP and the BLS private sector is now up to 77,000 per month. So it's not exactly spot on, and there's some scope for the ADP to be in line with the lower estimates on the street. Guys, I've seen other data that suggests the payrolls will be soft. Mm-hmm. Some of the high-frequency data we follow from Homebase, Goldman noting the big data. Also, maybe worth mentioning, in the ISM manufacturing report from yesterday, they said that mentions of job firings outnumbered mentions of hirings by 3 to 1. So I think the market has a, what's the right word, ambivalent relationship with ADP, right, because it's just not on. But as for perhaps spotting a trend or underlining the concerned softness, I think it probably does a decent job of that. Over the course of a 12-month period, the two are off by about 200,000. So over time, they kind of come together. That's only 14,000 a month. As for the Fed, this will increase pressure on the Federal Reserve to cut rates, but it won't change anything about the concern they have over potential inflation. So it really just kind of deepens the stagflationary concern that we've heard from Fed officials.
Yeah.
Meantime, the one and only Rick Santelli joins us from the CME for his reaction to those numbers. Rick, you've been looking at them, listening to Mr. Liesman. What's on your mind?
Well, I mean, definitely it's the worst job creation from ADP since March of 23. That's a pretty good stretch of time. We all know that the labor market, at least purported by all the experts, economists, and Fed personnel, is just kind of a ticking time bomb of slowness. It's going to definitely slow down. It's just a matter of when and what the rate of change is going to be. I don't know that I agree with that, but I do agree that the glide path is going to be headed down, but I think it's going to be a long glide path. And the relationship between ADP and the Labor Department's statistics that will be seen tomorrow, as Steve adequately pointed out, there's a wide spread there. When I look at what happened with JOLTS yesterday, when I consider most of the press and headlines over tariffs and the current administration's policies, it doesn't shock me that there may be more uses of the word firing than hiring. But maybe it's the contrarian end of this that we should pay more attention to. Maybe we should learn a lesson about what the equity markets did, about the kind of counter-trend rally we had that briefly pushed yields down, although I think that much of that may be in the rearview mirror. Ultimately, I think it's easy. Yes, I think the best days of the labor market are behind us, but I do think that there could be a resurgence down the road for a variety of reasons after we hit maybe a small speed bump, and I think that's the real issue here. Are we going to get a genuine slowdown or a small hiccup? I'm in the latter camp.
Can we just go for one? Can I just ask one question?
Yeah.
What do you think this is a function of? Meaning why? We're talking about AI. We're talking about tariffs.
So
talking about what?
Eventually, standing in place creates a drain on the job growth. The reason is because people leave the job market if you don't hire more people. So what we've heard is not so, and what we've seen, by the way, in the data is not so much firing, it's a lack of hiring. Over time, that creates saps the strength of the labor market if you're not replacing those people who leave, so the total employment level would fall. I think the uncertainty may be a major role here. And I also think that we've heard a lot of stories about small businesses, the ones who are importing stuff, the ones who take the imported stuff and make other stuff out of it, small manufacturers, they have been potentially hurt by this. Before any of the potential positives that are hoped for by the administration, the bringing back or the reshoring, before that has any effect. I think the key here, again, is this stability, which would people say, okay, I know what the tariffs are going to be, I know what the taxing is going to be, that would say, okay, I get the situation, now I can right-size my job, my employment, which may be higher, maybe lower, maybe the same. I would just point out, though, that it was the weakness in the job market. People debate the 50 basis point cut before the election. It was the weakness in the job market that was cited repeatedly by the Fed as to why they cut 50. They did so in a very different inflation environment than the one we have right now. And there are the probabilities now. I guess they're a little bit higher for October, a little bit higher for December.
Why was it a really different inflation environment?
Because you had declining inflation back then. Come on. You had stagnant inflation back then, exactly like we have now. The sticky last mile. Really, nothing has changed except for the way the Fed talks about it. It really hasn't changed much, Steve. If you look at the core numbers on PC, the core numbers on a lot of the data points, they're kind of stuck between 2.5% and 3.1%. Really, nothing has changed on that front. There has been some uncertainty. But whether you look at things in the past like long-term capital, the credit crisis, uncertainty, exogenous issues always creep up, and the Fed seems to be able to determine policy before they happen. I'm not sure why tariffs are so damn different. Rick, just real quick, you have across the board at least 10% increase in imports, right? And that will mathematically
10% what? Wait, I didn't pick that up. 10% what?
An at least across the board 10% tariff likely to be put on imports. So that's going to have some mathematical effect.
Right. And you're making that the center of your worry bead universe, although it's what? Imports 11% of the economy. Once again, I will stress, we are overplaying the uncertainty Trump tariff card. And Trump's overplaying that he's not more hyperbole than fact on how rigid this is going to be.
What is it?
And both of these are going to meet. What is what? I think, we just made new all-time highs in stocks. I don't know. I think things are pretty darn good.